2, 1, and we are live. It's Masterclass time. Welcome, everybody. Multinational meets stablecoin. Very excited on this webinar today. This will be different. This will be new. Questions will be answered. Welcome, audience. Great to have you here. I hope you learn a lot today. Do not lean back. We have questions for you. We want you engaged. We want you in the chat. And in about 1 or 2 minutes, we will start with the poll questions. So have your hands on the keyboard. We want your answers. Let me introduce your audience here today. We have Tanya, ladies first, Treasury Masterminds board member and head of finance at Wave Access. We have Noah Herman, Chief Strategy Officer at Fortris. And we have Nick, the co-founder of Zodia Markets. Great to have you guys. This will be a perfect panel. I'm Patrick. For those of you who do not know me, I'm the founder of Treasury Masterminds and Pecunia. I will be your moderator today. Feel free to use the chat for questions during the session. We have 5 minutes at the end for question time, but ask them if you want to during the sessions. I will see them. If they make sense to be asked in between, we will do that. But let's start with the masterclass and the webinar. Let me start with asking you, the audience. Most treasurers hear stablecoins, think, "Ooh, it's risky, headlines, what's going to happen with them?" So let me start with, do you currently use any crypto stablecoins in your company for whatever reason? Investments, payments, whatever, can be stablecoins, can be crypto. Number 1, yes, actively using it. Number 2, we're starting pilots. Number 3, no, we don't using it, but very curious, probably the reason why you're here. Or number 4, not at all, or I'm not allowed to use them. So 1, actively using them. 2, starting pilots. 3, no but curious. 4, not allowed to use them. Put the number in the chat. We will see it from there, and we will go from there. Let me see what we're getting in. A lot of 4s, a few 3s, still 4s. There's number 1. That's very good to see. Is this something we expected, Noah?
I think so. I think that's pretty standard. If there are 50 or 100 people, to have one of them, I think one was actively using.
Correct. So far.
Probably makes sense.
Yeah. So a lot of 3s. That means no, not using them, but very curious. I think that's good news. It starts with curiosity. What is it? Well, how can we use it? And that's why those people are here. So let's start with that. Tanya, explain stablecoins like you're talking to a treasurer who has never heard of them.
Right. Thank you. I'm honored to do that. So I think we can start by just saying, again, my background is in corporate treasury, so I like to frame things that are, in the way that treasurers think about things. So stablecoin is a digital asset, a crypto asset that is kind of tied in the value to the usually it's I'm sorry, I'm stumbling a little. I just got lost among my screens. Sorry, I see you now. So a crypto asset that is tied in value to reserve value. Usually it's a US dollar. And I'm sure Noah and Nick will expand further on the nuances of this and of how the stablecoins are used and in daily practice by the teams that they're working with. But for treasurers and for kind of corporate treasurers, I wanted to mention that first of all, we can think about stablecoins as a payment method more than a security, I think, because it can be both. But per the Genius Act that was enacted in July of last year, they kind of want to focus specifically on the on the value of stablecoin as a payment method first. So I think, and today we're going to cover use cases that are related to payments, to the speed of payments, and to the cost of payments, and also the FX component of it. So I think this is the main use case for treasurers to think about. I also wanted to say a few words about the different, I guess, sources of kind of different issuers of money, so to speak. So we can think about central bank money, we can think about commercial bank money, and privately issued money. So stablecoin will sit in this last category, the privately issued money. And this is why it's so important to differentiate it from the other types of money. And CBDCs, which would be central bank issued tokenized funds, is a different thing, specifically because of the issuer. So just wanted to mention this component as an important one. So we're not just talking about blockchain in general. Today, we're talking about stablecoin, and it's important to understand the issuer for this. So I'll stop.
Great. No, but great point. So stablecoin is on the agenda. CBDCs are not on the agenda here. It's sort of a stablecoin, but it's very different. Not too many use cases there. More restrictions. So Nick, let me go to you. So Tanya covered the basics. So what makes a stablecoin stable? But let's also focus not on the pros, but also on the cons. How can it break? Treasurers are not always trustworthy, but they want to see the other side of the coin as well.
Yeah, so I mean, stablecoins have a little bit of a historical precedent. So I mean, if you can visit the UK, which I know you are next week, Patrick, and somehow a Scottish banknote has made its way down to London, I don't think you'll be able to spend one. Now, Scottish banknotes created in the 1840s. They're backed by British banknotes, by Bank of England banknotes. So they're literally one of the earliest versions of stablecoin. And that probably helps illustrate the structure that all we've done is take something that pre-exists and digitized it in a sense. So what we would do, Zodia Markets is an entity that has relationships with the issuers. The issuers are private sector companies. So Tether, for example, Circle, Paxos, Ripple, etc. We onboard with them, KYC, due diligence, operational setup. We sign their terms and conditions and so on. And what we do is we send them requests to purchase stablecoins. They agree to the request. Now we move to settlement. We'll deliver dollars, usually dollars. Dollars account for 95+% of stablecoin market cap. We deliver the dollars from our bank account to their bank account, and they will mint a stablecoin from something called a smart contract onto a blockchain, and that will be in our wallet. Or they'll mint it in their own wallet, and then they'll deliver it to us. The outcome is the same. They're sending us stablecoins. Now, the way to think about a stablecoin is it's a representation of cash on the open internet, and the rails it sits on are the blockchain. Now, what they do with the dollars, which is pertinent to your question, is they take that and they'll invest it usually in an asset of some kind, and most commonly on the US side, it'll be short-dated T-bills. So from memory, the weighted average maturity of Circle's T-bill holdings, I think, are about 10 days, maybe give or take a couple of days, but it's very, very short-dated, extremely liquid, extremely short time to maturity. There could also be some investments in fully collateralized repo and reverse repo, again, sort of fairly straightforward. And then there's also going to be a component in cash, because at some point I might want my cash back. So I'll go to Circle again or to the issuer. I'll say, hey, I would like to redeem. They agree the transaction, obviously make sure that I have a relationship with them, KYC, AML, etc. And then we move to settlement. So I'll return the stable coins, this time to a burn address, and the burn address literally does what it says. It makes the stablecoin disappear, and then they'll send the cash back to me. Now, digital assets, the whole point is you're using it for speed. Okay, so the speed is going to behave much more like email behaves rather than a cross-border payment. Okay, so email is 24/7 available and it'll send in minutes and seconds. So they will receive the stablecoin and they'll need ready cash to be able to help me redeem. Okay, that ready cash is the last component generally of what we would call the reserve. So collectively, the reserve is going to be short-dated T-bills or some other kind of government security. You could also have repo and reverse repo, and then you'll probably have a cash component. That's most common. And indeed, if you look at things like the Genius Act regulation in the United States or MICA, there is requirements that it be any of those. There can be some variations in terms of proportionality and all those sorts of things, but generally it's variations on a theme. There are other types, but they tend to be much smaller. So gold-backed stablecoins, it's again conceptually similar. You get a token, there's gold in vault that's represented by that token. So that's in principle how it works, quite straightforward.
And there's an amazing question there. What if the issuer goes bankrupt because it's privately issued?
It is. So yeah, so in your question, so that the way we look at it is we go through the sort of principal risk types that any regulated financial services organization or bank would think in terms of. So it's just a nice framework just to hang your risk management hat on, if you like: capital liquidity risk, compliance risk, operational risk, etc. The one you're looking at, so it's mostly credit risk and to a lesser extent operational risk and capital liquidity risk. So if I take one example of a DPEG, because we want one stablecoin to equal to $1. Okay, that's the most important thing. So you effectively want X, which is the reserve, to be bigger or the same as Y. Quite a simple calculation. If we look at Circle back in March 2023, so Circle held some of their cash in one or more, I forget which bank or banks, of Silicon Valley Signature and Silvergate Bank. Now those banks collapsed, and as a result, Circle wound up short. I think it was about 3% during the period when the FDIC was deciding whether to rescue those banks. And eventually they did, and they bailed them out. So it makes Circle whole. That's the danger. When we're onboarding a token, we would also look at the segregated nature, or how segregated the assets of the reserve are. So if the issuer does collapse and fall apart, is the Treasury's book, and I'm going to use that term sort of quite loosely, but is that reserve, is that Treasury's book segregated from their balance sheet? Again, that's contractually a fairly simple question to be able to check. And therefore, am I going to be able to go to their administrator with the tokens that I've got on the chain and go, hey, I've got 50 tokens, you owe me $50, can you make me whole? And we'll go through that. Yes, that'll take a period of time, but I just know that my money is there safe and sound.
Yeah, that makes sense.
If I may expand just a little on this, because as Nick said, definitely look at it as an operational risk. And as I mentioned, like the three categories, right? So, and we just kind of discussed privately issued central bank money, but commercial banks and deposits and loans, that's also a source of origination of money. And so, and it's very similar risk. And so we all as treasurers assess our bank relationships and our partners, and there is risk tied to many issuers.
I think the interesting thing, just to dwell on that slightly more, is the scariest part of a stablecoin issuer's reserve tends to be the cash that they're holding in the banks. We're actually less bothered about the repo, reverse repo, and the treasuries. They're often held in segregated custody. They're often managed by broker-dealers. Broker-dealers are subject to client fund manager, FBO, client funds rules, or CAS in the UK. We're speaking in those terms. So it's often the cash in the banks that's the scary part. And that sort of then turns the whole thing on its head. Because if you're looking at a stablecoin is going to be collateralized 100+%. Genius requires that. MiCA requires something similar. Whereas deposits held at a bank is a loan to the bank. The bank is capitalized 10 to 15%. Now, if it's a GSIB, fine. If it's got deposit insurance, fine up to a point, but those tend to be in sort of retail sums. But if we start to look at an emerging markets bank in, I don't know, a country with dreadful sovereign risk, I'm not going to pick on South Sudan, let's pick on a country. How comfortable would I feel about holding dollars in a bank in South Sudan versus, which is capitalized at whatever it's capitalized plus the sovereign risk, versus holding a stable coin that's capitalized 100% plus?
Yeah, no, fair explanation, and it's a matter of trust. That's what you both basically are saying. A bank can also fail. Yes, a stablecoin issuer is a commercial company, which can fail. A bank is as well, but the bank holds your money. If they fail while holding it, you're at risk of losing your money. Of course, there's a central bank as an issuer, which we might trust more than a commercial party. But given your explanation, Nick, a stablecoin is one-on-one backed. A bank is maybe only 10% solvability, 15%. That makes it weird. If you say it that way, let's not cause a bank run here. But it's all based on trust here. Noah, over to you. Why are corporates suddenly calling firms like you? Maybe quickly introduce what you do. But let me have your story.
Sure. Yes. So great to be here and with this group, and hello to the audience. And yeah, so I am the strategy officer for a group called Fortris Global, which is really a set of what the industry would call enterprise crypto wallets. That's what we are, which is another way of saying we basically operate like a bank, but on chain with accounts. So very, very similar to sort of your typical Web 2 technology, but we are what in the parlance is called a Web 3 group. So technology that in essence acts as a treasury operations center. That's my group, and I've worked with and known Patrick for quite some time, along with his team, and I've also worked with Nick and his team for quite some time. So with that, yeah, I mean, I think there are many answers actually to your question, Patrick. We've seen, by the way, my background, just to echo Tanya's, and I can just say for the group that Nick himself comes from a long history of banking, traditional financial banking. I also did. In fact, my last role was with a group called ABN AMRO, which happens to be a Dutch bank running basically cross-border trade finance transactions. After which I stepped into the fintech space, ultimately into crypto. So even back then, we were hearing about corporates who were listening. I wouldn't even say they were curious, but they're listening to sounds on the ground, to their teams, to their treasury teams, whether that was their headquarters or maybe their local jurisdictional subsidiary treasury team, saying things like, this is complicated, this is hard to do, I can't find this money, this is getting expensive, where did that wire go, why is this taking so long? Very typical things for any corporate with more than one jurisdictional base. And so they were listening, and then they started to hear, which were words like blockchain and words like stablecoins. And this was a while ago. This is 2015, so it's been quite a while. That's a decade, and we still, apropos to what just happened with the poll, right? One person out of however many are on the call, maybe it's 100 people on the call. I think that's a fairly accurate proxy for the amount of corporates in the world that are touching stablecoins or thinking about touching stablecoins. So a representative group. And again, this is about a decade later. So why in the past 2 years has that accelerated a little bit? And I think, Nick in particular touched on a few topics that are relevant, as well as Tanya, one of which certainly in the Americas, which has lagged behind. And by the way, I sit in New York, so I can speak about my own country, but yeah, we've lagged behind quite a bit. In fact, been very hostile in the past to all things blockchain and stablecoin. But that's changed very, very quickly and very much for the positive. And as we've just talked about, the vast predominance of stablecoin issuance is on the back of US dollars, at least for now. So it is a big money center. It's a big financial center. It's a big now crypto center as well. It wasn't always the case. That I would argue, even though it lagged behind MiCA and MAS in Singapore and all of these other regimes that have sort of stepped ahead of the US is now finally catching up. And I think that's being observed by corporate boards and treasurers and the like. So that's one piece, is genius, and hopefully soon market clarity to pass as well. I think another maybe reason why more corporates are getting into the fold is it's been a long time. Tether has been around for, I think, 15 years maybe. Circle itself, I joined as one of the first go-to-market people there in 2019. So even that's 7 years ago, right? And the more that these groups continue to consistently build themselves, the more that they continue to secure regulatory cover, license cover, grow their market capitalizations, grow their customer bases, grow their media presence, right? The more that corporate treasurers will start to hear things like, well, stablecoin on blockchain really is a parallel rail. It's just a faster, cheaper, and less complex rail. And they're responding to that, right? So whoever was the one out of the 100 here who said that to the vanguard, right? And so those are some of the reasons. And then the others are just, I think, much more mundane, which again, Nick spoke to, and we can speak to more and in more detail in the call today. But that's just the ease and frankly, the simplicity and the, Nick mentioned it, right? Like we've operated on a fractional reserve system in banks. using stable coins on blockchain, you no longer have to rely on that. So for all those reasons, I think we're starting to see a move from the curious, the so-called crypto curious, into the maybe not crypto committed, but soon to be, and getting there.
Yes. No, definitely, and we're seeing that a lot of freeze. So I'm interested. Just waiting for the use cases. Maybe Tanya, let's make this practical. What pain are stablecoins trying to solve? Let's talk real use cases here. You already mentioned speed. Is that the main one? What would be a use case for stablecoin according to you as a treasurer?
Yeah, and I also would love to hear from Nick and from Noah, from their experience, because I personally, as a treasurer, I have not worked with stablecoin. I can see a use case very clearly, though, for at least one of the companies I worked for as a treasurer. They had to pay cross-border for the purchase. Well, they were kind of a distributing company in the US, so they would bring products from China, from Vietnam, from Asia in general, and they had to pay there for the product, and then they would distribute it domestically in the US. So all these payments that would go cross-border, so very familiar with how painful this is to just wait for the receiving party to actually give you kind of green light, yes, received, proceed with your next step. So sometimes, unless they would receive a payment, they wouldn't start to produce the product. So it can be really, really painful. And treasurers, kind of, especially leaning to the conservative side, they like to say, yeah, it doesn't really matter how soon we part with the money. We want to hold on to it as much as possible, which is true. If it is sitting in the interest earning vehicle, yes, you want to hold on to it. As soon as it's in the cash cycle, as soon as it's operational, I'd rather you need to think in different terms, right? So not think, and in the US here, people also like to talk about checks still. So I mean, and there's a huge gap between what we're talking today and that. But just to mention, there's still this stigma that, oh, if it's not clearing fast, maybe it's better for us because we still have the money. But do you really have the benefit of having this money or not? So I'd rather you actually think about this. And so if it's in the cash cycle, push it further as soon as you can, because that's how cash cycle works. The faster it goes, the more benefits you reap from it. And then if it's in your investment vehicle, great, then push it there as soon as you can. Again, the speed matters. So to me, that's what treasurers should think about in terms of speed. So not for the sake of it, but for those benefits. Just know where your cash is and have it in exactly where you want it. And then as far as the programmability, I just have to mention this too, because programmability of payments only starts when payments are truly digital. So right now, without like CBDCs, the money is not electronic. So banks make money electronic in the kind of legacy, so to speak, environment. But digital money, something yet different. So that's why we're talking about tokenized money. We talk about tokenized deposits, something that originates within banks. We talk about privately issued stable coins, which is also digital money. So true digital form of money allows you to program it, truly program, not go through batched files that you send between your bank and your ERP system and then your trading platforms and whatnot, but truly digital information typed to digital payment, allowing it to be built in a smart contract to actually be triggered when needed. I think it's a very powerful thing too for treasurers, because this way you can truly automate your processes to, up to 100% of it. So
yeah, no, that's a fair point, because the money we have on the bank account now is not really digital money. It's an
electronic ledger in your bank.
Digital form of actual cash, because they are supposed to be cash behind it, not bills, but cash. So stablecoins are real digital money. That's what you're trying to say, and it's not a new word, because if you still use digital money, we think of bank on our bank account, cash at our bank account is also digital money. But I might be confusing people now.
Well, I have a way of trying to explain it, if you like, very quickly. So the way that money as we understand it today is not based on the internet. It's not enabled on the internet. So if I look at the US dollar, then US dollar, the real-time gross settlement system, the main clearing system is obviously called Fedwire. Fedwire, if you peel it back, is a series of Oracle databases. That's all it is. There's actually, you can Google it, there's an instruction manual with Oracle branding written all over it. It's literally an Oracle database. If you look at CHAPS, if you look at all of the other real-time gross settlement systems, and very likely the faster payment systems, they're all just centralized databases. They are not on the open internet. That's why when you look to buy something online, you tend to have to go through a payment gateway. You get the pop-up, you do your security stuff with your bank, your card issuer, whoever else it might be. And that gateway is a gateway from the internet where you're doing your shopping, whatever else you're doing, through to these closed databases, which are mediated through banks and through the various other settlement infrastructure that sits between us and the government systems are actually moving the cash. All stablecoins are doing is bringing the whole thing right to the front end. So the cash is actually in the browser, it's on the app. And by bringing money onto the open internet, that's why it's going to start to behave like other things that we're used to using on the open internet. You know, if I send an email, it's going to you, Patrick, right now, it's going to arrive in minutes or seconds. If I send you a cross-border payment, it's probably going to take a day. It's going to take maybe 2 days. Can't send it at weekends. Can't send it after 5 p.m. local time, and so on and so on. We don't run email like that because it's on the open internet. It doesn't work the same.
Yeah, and that's what we really want. I want you to send me an email, including 10 stable coins, and they arrive at the same time. That's what I really want. But run us through one of these payments, because that's the concept. How does it in practice work? I see quite a few questions on the chat, like how does it really work? Walk us full payment flow.
You've got to source it first. So there's two ways, broadly speaking, two ways you can source it. You can either go to the issuer directly, in which case KYC, screening, you'll sign their terms and conditions, et cetera, and you'll be able to buy from them directly. That's quite common with Circle, for example. They have a very large number of customers. And setting up with them is reasonably straightforward if you've got even a fairly small fintech or a corporate or whatever. So you can buy it directly from them. And again, it's the same mechanics I described at the beginning. You give them instruction. I would like to buy stablecoins. Think of it almost as a bit like a foreign exchange trade. I have cash. I want a different type of cash, except this one's on the internet rather than being a foreign currency. Can we do a trade? Done. We move to settlement. I send you cash. You send me the stablecoins, or the inverse for a sell. The second is you can go to a crypto exchange or a brokerage or some other sort of form of distributor, if you like. That's the role that Zodia Markets plays. So we've set up relationships with all of the major issuers. So that way you can choose amongst a selection of stablecoins, because obviously each issuer is only going to sell you their stablecoins. So that can become quite onerous. You have, rather than opening 5 or 6 relationships, you just open one and you get 5 or 6 stablecoins as a cohort, as an ensemble. The way that it settles, I mean, you can get into quite a bit of technical detail, and I tend not to like getting into sort of blockchains, because I think we definitely would lose quite a lot of the crowd. But again, think of it as you have an address, okay, a blockchain address. Think of an address as an IBAN for crypto or for stablecoins, okay? It's simply an identifier, and you can say, please send the stablecoins you want to send me to this place. Now, the identifier is pseudonymous in the same way that a personal email is pseudonymous. So let's pretend, for the sake of argument, that Noah Herman's personal email is nh@gmail.com. It could be Noah Herman, it could be Nigel Hawthorne, it could be Nathaniel Havers, we don't know. So when we're onboarding someone, a counterparty, an entity like ours, we do KYC, as in due diligence, on the actual person. So if it's natural persons, we'll ask for proof of address, passport. If it's a corporate, certificate of incorporation, et cetera, et cetera. So we've got the actual real-world identity. What we would then do is we'd say, hey, send us an email with a secret code from your email address. We'll then tell you what the code is. We'll write our own secret code. We'll send it back, and then you tell us what we wrote. Okay, if that completes successfully, now we've been able to tie Noah's real-world identity to nh@gmail.com. We do something similar with digital assets with penny tests.
Yeah.
I need to move rooms, but that's how we manage that.
No, clear. So Noah, that's basically your wallet, my wallet. You bought the USDC, the circles, $4. You have these USDCs in your wallet now. I sent you my wallet address. You sent me the USDCs. and within a few seconds I should have the USDCs transaction complete. I do have your email plus the 10 stablecoins in my wallet now. What I do with it now, up to me now. I can keep the stablecoins, of course, for as long as I want them, or I have my wallet. I maybe have them tied to an exchange or to a PSP. It can be a wallet with you guys, a wallet with Zodia Markets, where I can trade them immediately, and then can make them real US dollars again, and then I'm back in the banking system. Is that correct?
That's correct.
Yeah, that's correct. that's
Sorry about that. Go for it now. Pardon me.
That is exactly right.
Good. So Noah, so is this about speed only, or what about control and costs? Because I saw somebody mentioning, how about the costs? Do we really need real time? What's the real advantage, or is it all of the above? Speed, cost, control. Let's replace cash after all.
Yeah, so it's a great question, and I think the answer is, so to my mind, right, I'm just a person who operates within the crypto environment. I would say it's all three, not always all the time, but it is important to note that pretty much on any on-chain stablecoin transaction, you are automatically going to be paying less for your transaction. You're going to be moving it faster than you otherwise would, and you're going to have a much less complex overall financial transaction. Now, we worked with corporates for a long time, and you are right, Patrick, that some will say to me, as they have many times, especially the heads of FX, hey, Noah, I get it. Blockchain, stablecoin, new tech, really attractive. It's all the rage. However, we have 250 banks and 250 banking relationships. And there's nothing you guys can do to beat that, because time-wise, same day, right? Even in Mexico, doesn't really matter. And we'll say, okay. And so time is not that important to you. Totally fine. No challenges there, right? But that person inevitably will say, well, we are paying quite a bit for our corridors from X to Y to Z, A to B to C. Cost is a thing. And overall complexity will be as well. So I would never presume, in other words, to guess that all of the members of the audience, all the treasurers on the audience here, all will benefit the same from those three major categories, right? It's just maybe not true. It might just be one that you're seeking. And I have had many corporates, as I'm sure Nick has, come to us and say, we're not so much concerned about time, right? Or we're not so much concerned about cost. We are concerned about the other. And by the way, we have 10,000 reconciliation agents all around the world that have to deal with all this. So yeah, it's always one of the three, generally two of the three, and sometimes three of the three. And that pretty much is applicable to any treasurer, any corporate doing anything around the world.
Mm-hmm, mm-hmm. Let's ask the audience this. Guys, wake up again. I have a poll question for you coming. So hands on your keyboards, because I generally want to know, because we four can think of UK use cases, but we have 100 people here. Where do you see the biggest use case for stablecoins? Is it really, number one, faster international payments? Is it number two, 24/7 payments and pooling? Because it would allow me to pool worldwide, follow the sun approach on a minute-by-minute basis, hour-by-hour basis. Number three, freeing trapped cash, because that could be a solution too. Difficult markets, South Sudan, as Nick mentioned. Or is it going to solve payments in emerging markets where the rails are not stable, where the big banks are not active, and let's just skip the rails over there and go immediately to stablecoins? So number one, faster payments. Number two, 24/7 payments pooling. Number three, freeing trapped cash. Number four, easier emerging market payments. Let me hear it from you in the chat, please. Put in the numbers. So Nick, if I want to start an implementation now, what's the easiest way to start? What's an easiest pilot to start one of those?
Yeah, the first thing, well, the easiest is just to not touch the stable coins at all. So we do have a model to do that, whereby we'll onboard you, we'll do KYC, etc. We then execute a trade. Let's say you want to pay someone else with stablecoins. So we execute a trade, you deliver cash to us, we'll deliver the stablecoins to the third party. There's some due diligence we need to do on the third party, but we get that out of the way ahead of time. We do something called whitelisting their address as well. And we can do the inverse, so we can receive stablecoins from someone else and we can deliver cash to you. What does that solve? So the last one I said, so if you've got customers in certain jurisdictions where they just can't source dollars to pay for goods and services, the central bank often doesn't have one, or there's an uncertain period of time while they're waiting at the central bank window to see if the central bank will actually get the dollars to be able to sell you. And that uncertainty is often driven by the choices that central banks feel they have to make, because they have to prioritize things like pharmaceuticals to keep the healthcare system going, oil and gas to keep the energy system going, grain to keep people fed, etc., etc. So if you're, I don't know, an insurance company trying to repatriate dividends, you're probably going to be lower down than making sure the hospitals are fully stocked. So that solves that problem, because in some senses you can now go to an alternative source of dollars locally, which is crypto exchanges, crypto brokers, and you can buy usually dollar stablecoins. How are they getting them? They're often getting them from remittances. So if you're a taxi driver in New York, for example, and you're sending money home, traditionally remittances cost, I mean, there's some variance in the number, but it's about 7% is the average. So $14 to send $200. Whereas if you use stablecoins, it's going to be super quick. And in terms of sort of banking penetration and things like that, I don't need a dollar bank account to receive dollar stablecoins. I need one of those. Simple as that. Telephone. Or access to an internet cafe. That'll do the same. You get the same outcome. Yeah. So the second one is if you want to pay a supplier with stablecoins. So it's the corollary. So in some jurisdictions, again, stablecoins are more creditworthy than dollars in local banks. They'll move a lot faster, to Noah's point, because they'll move minutes and seconds rather than T+3, whatever an emerging markets bank might be able to achieve. And thirdly, there is zero chance that the central bank can seize dollars as if they're held as stablecoins, whereas they can seize dollars from the local banking system. Just ask anyone who had a dollar bank account in Lebanon in 2019. So as a result, if you're looking to pay suppliers, there's a very credible argument to say, well, I can pay you dollars, in which case I'll pay sticker price. Or if I pay you stablecoins, because stablecoins are trading at a 10% premium in your local market, you can knock 5% off of your invoice, please. That would be terrific. The second one, to actually be able to interact with the stablecoins more directly, where you've got Noah on the call. So give Noah a call. He'll be able to explain how the wallets can be put in place, integrate that with your treasury system, and so on and so forth. So you're basically looking for a wallet provider and or a custodian. And they come in slightly different flavors. There's a bit of a nuance, but fundamentally, you need somewhere to put it. Think of that as a bank account for your digital assets and stablecoins.
No, it sounds very logical and not complicated at all. And the way you mention it, it's like we all drive a car, but we don't have to fully understand how an engine works. We just need to know how to operate. And I don't think all treasurers know how exactly central bank clearing works, how SWIFT settlements work on the background. We don't need to know. We do know that sometimes a payment takes 1 day. We know the cutoff times. We know the mechanics. I think same learning curve in stablecoins. But something triggered me on your explanation and use case. It means I wouldn't even have to hold stablecoins at the end of the day or in a wallet. I just use them in between to settle what I need to do. My case is solved. So. Tanya, over to you, because as a treasurer, would I want to hold stablecoins overnight? Would you be comfortable with 10 million USDC, USDT on your bank account wallet overnight? Not talking about interest income, just holding it as an asset class, class.
Again, it doesn't really matter if I would do it or not personally, right? What matters is the kind of the risk policy within the organization, the risk tolerance rather, and investment policy. And I just said word investment, and yeah, it's inevitable. If you're holding, as from a treasury standpoint, if you're holding something, why do you have it? Like, right? So you shouldn't have something you don't use. Back to my initial point. So to me, unless you're earning something and I don't hold it, But again, there are many, many different processes and reasons why you could potentially end up with certain asset short term. So no problem with that. But yeah, there should be a strategy in place, I guess, for everything. So if there is a decision-making process, I would say start with the break-even calculation, and we do it for regular payments all the time. And I'm CTP certified, so in this certification from the AFP in the textbook, there are certain use cases already calculate, like models sort of that we all should be using. Like if you're paying with wires to certain geographies, and how many payments are you making, and is it worth the effort to push them out like as a wire or send an ACH? So what I'm saying is that we always should model, especially the cost increases at scale. So we should always model what we're doing in terms of cost. So this is not an exception. So if there's a truly a use case, and all the kind of models are showing that it's worth the effort, and there are certain savings that worth it, then it just boils down to how do we do it? What is the risk? What are we willing to take on, and what we are not willing to take? And to Nick's point, you don't have to hold them, right? If you are very much averse and you just don't want any accounting on this and all. And from my experience, I had to deal once with Bitcoin as a treasurer that was related to a donation that was in healthcare industry. So because they have very often foundations and they accept donations, so there was a question of accepting donations in Bitcoin. And so because we weren't prepared to deal necessarily with accepting Bitcoin and holding Bitcoin, we just went ahead and reached out to a partner financial institution and asked them, can you help us? So as easy as that. And I think that's what both Nick and Noah are kind of talking about. So just reach out to partners, or if you don't have any, seek to find them, right? And again, educational kind of calls like this could be a place to start. And so at that time, we reached out to a partner and we asked them if they can help us. And they said, yeah, we can accept this Bitcoin payment for you and just supply dollars to your bank account, and done. We said, yes, please, let's do that. We just signed certain paperwork and received dollars in our bank account that we informed them of. So as easy as that. So it's not always, if you don't make it an obstacle, it's not. So it's just a matter of your strategy.
No.
Very quickly, just on the holding, I think I could supplement Laura what Tanya's quite rightly said. We did some research with Standard Chartered, and we looked at the holdings, because you could look at the wallets. They're pseudonymous, so you don't necessarily know who owns them, but you can see the quantum that is in each wallet, and you can roughly geolocate all of the wallets. And what we identified is really it's a barbell. So one end of the barbell, a lot of holdings are very, very small amounts, and we sort of called these the Argentine taxi driver. So what are these stablecoins doing? They are replacing dollar bills that are stuffed under mattresses, right? People want to get away from the Argentine peso, and you can debate, whether that's right or wrong. It's just a fact. That's what people do. Argentina is the number 2 holder of physical US dollar bills after the United States, for a reason that I think we can all guess. At the other end of the spectrum, we have what we're calling the Mayfair property use case. Mayfair is a fashionable part of West London where almost nobody lives. It's very, very quiet. But it's very, very high value properties. And a lot of particularly foreign buyers buy property there because it's a return of capital use case. They're not necessarily renting them out. They just want to have somewhere to store their value. Obviously, property is very illiquid. So what both of these two ends of the barbell are doing is they're now using stable coins, because that's a much more liquid but equally sort of appealing way to do that. Now, in terms of the capital controls, there's a couple of questions that have come through. The thing about this, as I said, it sits on the open internet. So trying to prevent a lot of this, it's like trying to ban email. It's almost impossible, if not completely impossible. And again, I don't say that provocatively. It is just, it is just a fact from how the technology works. If you look at the top 20 countries in terms of crypto adoption, number 1 is India, where crypto is effectively banned, and number 3 is Pakistan, where crypto actually is banned. So again, not trying to say it provocatively, but you'd almost want to sit with the regulators and go, how's the ban going? Because it's not going well. And if you try to actually ban the internet, so last part very quickly, you can ask the last Nepalese government, which was deposed in August. They didn't even ban the internet. They just turned messaging software off. They were deposed within 48 hours, violently. So again, not provocative, but this is just an infrastructure question. It's pretty unstoppable.
I have to add in as well. I mean, Tanya's point, I wasn't expecting to reference, but I think it's probably valuable to reference one of our groups, one of the groups that uses our software in particular, and when it decides to off-ramp its holdings of crypto, will use Nick's group, is a group that everyone on the call will know. And it's Save the Children. Okay, so this is a very large, well-known, very conservative, by the way. I mean, it's 120 years old, which accepts $1 billion a year in fiat currency. But it's not always easy for people to donate. And the group wants to make it easier, obviously, to be able to give it funds, right? And so it was starting to receive some more stablecoin and Bitcoin donations. And it took us 3 years of working with this group to work with everyone within the organization. So this comment I'm making is with reference to Tanya's point, but it's really to the audience, which is to say there are very large, very well-known, very trusted, and very almost bread and butter corporates, nonprofits out there that are already doing this, that have spent a lot of time doing sort of the heavy lifting of, hello, board of conservative company, conservative organization. We need to find a way to safely, securely accept, operate on, and then distribute stablecoin and Bitcoin and hold it in our treasury for a while, right? Because that's what they want us to do. And they've done it, and we've done it. So for anyone in the group that needs a reference, more than happy to do that. But I think it's just relevant and apropos. And I wanted to surface it as to Tanya's point about find a partner, find somebody who's doing this, and just ask them questions. They'll be very happy to walk you through the process.
Yeah. Maybe then final question on let's name and shame. Which countries make the most sense? Where are the biggest use cases? Is it African countries? Is it South America? I've seen cases. I've seen screenshots from Bolivia where a vending machine was in stablecoins and not in local currency. I hear a lot about Nigeria where people prefer stablecoins over US dollars, USDC, USDTs. Is it those countries? Can you name a few, Noah, Nick?
I can, but I think actually Nick is better placed because in the end of the day, my group is the central tech. Think of us as the hub, right? We are the hub of the system, but it is really Nick's group and his relationships with local providers that are seeing the actual pricing, accessibility, volumes, liquidity in country. So
and weirdly, I have the list on a different screen just in front of me here. So this is not the whole top 20 because we'll be here for a while. But here's a few countries from top to bottom: India, Pakistan, Vietnam, Nigeria, Indonesia, Ukraine, Philippines, Ethiopia, Bangladesh, Turkey, South Korea, Thailand, Venezuela, Argentina. Yeah. There's a few more in there. It's 20, but there's a theme, very clearly a theme. So it's in terms of often young population, very engaged in the internet, use a lot of sort of Web3, Web2 technologies, things like that. You've got volatility of the currency, accessibility to banking, particularly dollar correspondent banking and by extension dollar banking, controls around the currency and obviously the volatility and inflation of the currency, et cetera, et cetera. So there's very common drivers.
Yeah.
And there's I would add on to that even with some of the groups that Nick and I have worked with closely for a while, those are all critical factors because they basically prime the populace to be able to engage with this. But it's really the top down as well. So if you think about Diageo is a good name, right? Good example of a group that has many times come to us and said, we have our global treasury operation is fine, it works, right? But in particular, in Latin America, we're having problems getting paid, right? We have problems being paid by our distributors because the currency is either appreciating, depreciating, ring-fenced, right? No. And so the sort of addendum there is that if you look at any multinational, they are more than likely to have customer centers, distribution centers, retail users in any major jurisdiction, right? Doesn't LATAM certainly, APAC as well, Africa surely, even the Eurozone. We've had shocking conversations with Eurozone, US-based corporates who've said, just simply moving our receivables from the Eurozone to the US can take upwards of T plus 30 days. And that shouldn't be the case. Why is that? Can we solve it? We said, yes, let's look into it. So.
Yeah. Amazing topic. I even learned a few new things today. I think the audience did definitely. If you've seen the discussion, I tried to read it a bit. People were helping each other. I think we answered most of the questions. I think we can go on for another hour. We already ran over time. Tanya, Nick, Noah, so much thanks to you for making this masterclass a real success. We taught some people new things here. They want to open a wallet, go to Noah. If you want more use cases, go to Nick. If you want to brainstorm with a treasurer, go to Tanya or come to me. Take this offline. We're easily findable on the internet, which is not blocked. So find us, send us an email. That's immediate. So thanks, audience. Thanks for having us, and have a look out for our next webinars via Treasury Masterminds in a few weeks. Thanks, and have a nice day.
Thank you.